Hey guys, welcome back. In today's video, we're going to take a look at my dividend growth portfolio and just see how things have changed since our last update. I'm Tex. If you're new here, I share my journey and experiences with trading and investing in the stock market. Really appreciate you watching. Let's get started. Alright guys, so here we are logged into my Fidelity account, and you can see the particular portfolio I'm talking about here is our dividend growth portfolio, balance at $36,246.74. Now obviously I have made several deposits since the last update. Every month I try to deposit as much as I can into this account, and basically again the idea behind this account is to take any extra cash that I have after I pay my bills and after I max out my retirement accounts that I'm allowed to by law, and deposit that into this account, because right now with interest rates near zero, if you put that money in a savings account, it's going to earn you basically nothing. So of course you want to have some money in a savings account that's very liquid as an emergency fund. If something breaks on your car or your house, you need quick access to that money. But the rest of it you can put into, for example, a taxable investment account like this, and you can invest it in dividend paying stocks or growth companies, whatever you want to do, so that you put that money to work for you more than you would just sitting in a savings account earning basically nothing. So the idea behind this again is to invest in mostly dividend paying companies, but we do have some high growth stocks in here as well, so we kind of get the best of both worlds. You get your capital appreciation and you get your dividend growth. So overall, I mean, the accounts, we are sitting up 12.83%, or about $3,000 in unrealized gains. So doing really well. Obviously, with the market continuing to head higher, the portfolio has done really well. And our core holdings really hasn't changed a whole lot, but we have sold some companies and I did pick up some new holdings. So we're going to talk about that in just a minute. But overall, I mean, like I said, you can see the core holdings are still there. I have added a bit to some of those positions. And because I do deposit new cash into this account every month, I do currently have quite a bit of cash that I'm working on getting invested. But again, I do want to keep some cash on hand in this account. I have no bonds invested in this account, which typically you would have an asset allocation of stocks and bonds. So instead of the bonds, I'm holding some cash in the account, and the majority of the rest of the money is invested in stocks. And so that cash can be used as if I need to dip into that for something that exceeds my emergency fund in my savings account, I have access to that. But also if there's another big dip in the market, I have cash on hand ready to go. Trying to keep the cash around 15%, but currently I'm quite a bit over that mark, so I'm going to start getting more of that money invested here this next week in particular areas of the portfolio that we're going to talk about. So first of all, what I want to do is talk about the newest holding in the portfolio, and that is Intel. Intel sold off quite a bit with their last, I believe it was their last earnings, and news that their newest chip that they're still developing is going to be delayed. So that's been a boon for their competitors like AMD, but AMD is basically just getting at valuations that obviously I don't want to buy it at. Intel is a company that's been around forever. I have their chip in my computer. You probably do too. I don't really see them going anywhere. I think that it's probably going to be some time before they can really, get back to being a leading chip producing company. They just need to get back to better innovation than their competitors. And it could be just a cyclical cycle. They're lagging behind now, and in the future perhaps they'll be back on top. But additionally, they pay a really good dividend. So I like it from both a perspective of a solid company that has potential to grow in the long term, but also they've paid an uninterrupted dividend for 22 years. So overall, I mean, it's kind of the best of both worlds. Now, I've only invested $600 in it so far. And it obviously has a lot of risk that it could continue lower. If we go to the technical chart, I liked it, especially because on this big gap down in the sell-off here, I look at the weekly chart and it came right down into that 200 moving average. And every time it's done that, it has held it. So this may be the time that it doesn't hold it. And that's, again, perfectly fine because I am looking at this as a long-term investment. But it's a nice dip in the stock, so I saw it as an opportunity to go ahead and pick some of the shares up. And if it heads lower, we can always add more in down the road. But again, so that's where I picked up Intel overall. I mean, like I said, you look at AMD, it's really it's been a boon for AMD. But again, it's hard to buy AMD at these valuations up here. Could it head higher? Sure, it could. But It's just not something that I would want to buy at this point in time. So Intel, that's the newest addition to the portfolio. Now I have sold some of the holdings. Let me pull this up right here. So this is what I have actually sold in the portfolio. Those stocks include NRZ, New Residential, which of course was that mortgage REIT that we talked about. And really that was just a terrible investment on my part. I didn't really do enough due diligence and fully understand the risk associated with a mortgage REIT. When the market sold off in March, I was down, I think, almost 90% on that position at one point. So I ended up selling it for a little over a 50% loss, which of course I hated to do. But realizing that I didn't fully understand that particular industry and the fact that there was still a lot of risk associated with it, I just decided to cut bait and run. Unfortunately, that was realizing a $634 loss there. So I did sell that. That was quite some time ago, and we've discussed that before. Since the last update video, though, I have sold Delta Airlines. I was able to sell it when it did pop up a bit before it came right back down. Overall, Delta Airlines is probably positioned better than a lot of the other airlines, but they did cut their dividend, and probably it's not going to come back for many, many years. And additionally, because of the persistent outbreaks that are continuing to spread across the country, people are still reluctant to fly. So I think it's going to be quite some time until the airline sector is really able to fully recover. If I had been patient and held it, probably would have went green on it, but I decided to just go ahead and take it off and put that money to better use into companies that are actually performing well right now. So unfortunately, I did realize a little bit of a loss on it, but again, all of this is just going to be tax loss harvested at the end of the year. So it's not the end of the world. It's just going to be written off on my taxes, up to $3,000, but we've only realized $621 in losses. So all of that can be tax loss harvested, so I'm not overly concerned about that. So just cut that one off on a bounce up. We were obviously down quite a bit more on that position before I did sell it. Wells Fargo was another one that I sold. I didn't quite get out break even on that one. I did end up realizing a $69 loss on it. When I bought Wells Fargo, it was one of the first companies I bought when I started the portfolio. And again, I just didn't do enough due diligence on it. I bought it because I needed more diversification in the banking sector, and it paid a really good dividend. And that high yield was awfully tempting to buy it. But in terms of the fundamentals, I do not like Wells Fargo. Could they turn things around at some point in the future? Perhaps. But I like JP Morgan better. I like Bank of America better. But overall, I'm not a big fan of financials at all right now. So I decided to cut bait on that one. Took a little bit of a loss on it, but at least I don't have to worry about it as much because, like I said, it's my least favorite in terms of the financials. So those are the losses. I ended up selling IBM recently. When the earnings came out, it popped up very nicely, and then it came right back down. So IBM is definitely a laggard in the technical sector. It's in the technology sector, I should say, but they do pay a good dividend. And again, this is one of the first stocks that I bought as well because it gave me a good dividend paying stock in that technology sector. But again, I decided to just cut bait on that and put that money to better use in stocks like the Trade Desk and Apple that have done really, really well. Microsoft is another one. So we're out of IBM for a very small gain. Really didn't sell it for the gain, just sold it to put that money to better use in other areas. Ralph Lauren was a stock that I picked up for a very, very short period of time. Initially, they did pay a dividend, and then it got cut. And then the fundamentals really changed to the point that I just didn't like it. It changed so quickly that I decided to just cut bait and run on that one as well. When I bought it, initially it jumped up. I was up over 20%. In hindsight, I probably should have just taken it off, but again, I was thinking more long-term on that one, and it just came right back down. So ended up closing it out for a very small gain. Again, not so much closing it for the gain, but just closing it because I didn't really like the investment long-term anymore, and again, that dividend did get cut. So really kind of one of the main reasons that I bought it meant that I had no reason to hold it any longer. Now Roku, this was not really intended to be a long-term investment. This was a technical breakout on the chart along with strong option flow coming through. So I picked it up, and in a span of about a week, I got a 26% return on it, and a 26% return in a week. I just locked it in, so recouped some of the losses that I had realized from NRZ and the others. So overall, like I said, $621 in realized losses, but again, our overall portfolio unrealized is up over $3,000. So we're not overly worried about that, and we'll just tax loss harvest those at the end of the year. The trade desk is probably our best performing stock if we sort in terms of total gain loss. 108% return on that one. I did add a little bit more to it, but it's getting hard to buy it up here at these current valuations. Store Capital is a real estate REIT. It's done really, really well since their last earnings came out. We got another big spike up in the stock. So this one, I initially invested $825 into it, and we're at 54%. So really nice return on that. Apple, incredible run, 48%. Again, though, tech just is starting to feel very, very overvalued up here. It just feels like it's getting tired, and the more it keeps just going up and up and up into this potential tech bubble, the more likely that we're going to get some type of really aggressive correction. And I've got cash on hand ready to go if that does happen. But in the meantime, it's been a great return for Apple, up 48%. Home Depot, Emerson Electric, Nextra Energy, Target, Microsoft, Nike, Royal Bank of Canada, Disney, nice pop up on their latest earnings. All of those rounding out over 20% return so far. So those are really good. Very happy with all of those. So in terms of, like I said, the core holdings haven't changed a whole lot. I have obviously deposited more money into the account. So I'm currently sitting in quite a bit of cash on the account. And I need to get a little bit more of that invested. We'll look at the asset allocation here in just a moment. But there is a holding that I want to sell next week. So I'm thinking about going ahead and selling Dominion Energy when the market opens next week. We're currently up 2% on that. Really haven't gone anywhere. It's paid a really good dividend. However, Dominion Energy is, they announced a major divestiture. They sold, I believe it was something to do with their natural gas, business segment to Berkshire Hathaway of all people. And there's also some political headwinds in Virginia, which is their primary market. I believe they're also in North Carolina as well. So I was reading an article about that, and the fact that they are going to cut their dividend in Q4 because of that divestiture basically leaves me to not really like it anymore. This is our dividend growth portfolio here on Simply Safe Dividends. So if we go and take a look at Dominion Energy, you can see that it has been downgraded, its dividend safety score to unsafe. So if we click on this, you can see right here that it says Dominion announces major divestiture, which will result in a Q4 dividend cut. So I don't like the dividend streak, unfortunately, 30 plus years without a reduction, and now they're finally going to get a reduction. So we have the dividend's going to be cut. There's still going to be a dividend. The current yield, I believe, is, the current yield is 4.66%, and I believe I read that it's probably going to drop it down to about 3.5% or so. So it's still going to be a pretty good yield. However, the fact that they are going to cut that dividend, and the fact that it does have those political headwinds, in general, just a risk that the stock could actually decline in value on top of the cut in the dividend leads me to not really like it so much anymore. So I'm thinking what I'm going to do is I'm going to sell Dominion Energy and take those proceeds and put them into Duke and Nextra Energy. I thought about adding another utility company to replace Dominion Energy, but right now there's not a lot that I like. And at some point I just want to be very careful about being too diversified. Diversification is a very good thing, but if you are very actively managing your portfolio, you don't need to be overly diversified. So if it's something that you're concerned about, you do want to be very diversified. People who just don't want to have to think about things, they buy an index fund and they don't worry about it because they know that they're diversified and they can pretty much just set it and forget it. But this was meant to be an actively managed portfolio, so I don't need to be overly diversified. In fact, I would not be opposed to selling some more holdings if I see, fundamentals change or I see reasons to do that. So I really don't have a problem with that. We'll just stick with Duke and Nextra Energy if we sell Dominion Energy. And it looks like if we can get out for, not a loss on it, that'd be great into next week. So that's really the plan there. But when we take a look at the spreadsheet, you can see that the earned dividends so far through July is $242.08, and the current portfolio income is sitting at $801. Also, the current portfolio yield is right at 3%. So that's not bad considering that we have kind of a mixture of high growth and dividend paying stocks in the portfolio. For example, we have Google that doesn't pay a dividend, but you would consider that typically a more high growth stock. It's a technology type stock, although it falls in the communication sector. You have Disney that used to pay a dividend, and they might bring it back, but currently there is no dividend on Disney. Another big one is the Trade Desk, and that's been a really incredibly high growth stock, again up 108% on that position. So it doesn't pay a dividend, but it does provide that really good capital appreciation. So all things considered, a overall portfolio yield of 3%. That's not bad. I'm very happy with that. If we take a look at our asset allocation, you can see that I'm currently sitting in quite a bit of cash. I've got 26.7% in cash, and really I want to be at about 15% in cash. And again, the idea of this account was to take that extra money that I have on hand and put it into this account, and that way I can let it work for me. But I do need to keep some cash on hand because I have no bonds invested in this account. Now, your typical asset allocation for a more aggressive growth portfolio might be something like 15% in bonds and the rest in stocks. Since I don't have any bonds in this portfolio, and I'm not planning to buy any bonds, what I want to do is try to keep about 15% in cash. That way, if I were to need that money, if some expense came up that was above and beyond my emergency fund that I keep in my savings account, I could dip into that cash if I needed to. But also, I have that cash on hand if there is some big decline in the market, that I will be able to more aggressively add into these positions or pick up new stocks that I like at lower valuations whenever some pullback does happen. So right now I'm quite a bit over that asset allocation. I'm sitting at, like I said, 26.7%. So I need to get more of that invested. So what I'm thinking I'm going to do is, again, sell Dominion Energy, take those proceeds, put them into Duke and Nextra Energy, and then I'm going to take this cash. I've got about $4,200 in cash that I need to get invested in order to get back down to that 15% of cash in the account. And I want to take that and I want to put a lot of it into real estate. So I upped the asset allocation on real estate to 15%. Previously, I think I had it at 13%. And technology was at 13%. I dropped it to 11%. And the reason being is because, again, I think that tech is kind of getting into a bubble scenario here. I think it could easily continue to go higher, mind you. I'm not necessarily saying that tech's fixing to crash next week, but I do believe that especially if a vaccine does come out by the end of the year or early next year, tech that has really benefited from this whole lockdown or businesses closing, they've been able to continue to churn out solid profits, where real estate has really suffered because businesses have had to close their doors. And so the real estate REITs, they haven't been able to collect all of the rent payments that they would typically get. Businesses, or obviously new businesses are not opening up. They're not signing new lease agreements and things like that. Real estate has obviously suffered. But if a vaccine comes out and we can return to normal, then real estate has a huge, huge potential to rebound. You can even just look at the technical chart. If we go and take a look at VNQ, which is the ticker symbol for the ETF, for the Vanguard ETF that tracks the real estate sector, it looks at your weekly chart, and this is the big sell-off here. I mean, a huge, huge sell-off, obviously, with the risk associated with real estate. It's rebounded about half of that move, but it still has a lot to go. And when we talk in terms of long-term, real estate actually has done better than tech when you're talking about very long-term. Tech has pockets of incredible returns, and if you can find those pockets, you can get really, really good returns. But there's also pockets of very kind of poor returns that kind of eat into those really great returns. So in terms of long term, in terms of very long term, real estate has always done really, really well. And I just don't foresee that changing. In addition to that, you have interest rates that are near zero and probably unlikely that they're going to be raised for many years. So you have investors who have all this cash that earns virtually nothing when it sits in cash in a savings account or in your market fund account, in your investment account, just sitting there uninvested. And they're looking for places to invest that money where it can essentially work for them, where they can collect interest or dividends. And real estate REITs are really great ways to collect dividends and allow you to grow your account over time. And so I think that, if there, like I said, if there is a vaccine that comes out end of the year, next year, whenever that may be, technology would have the risk of really kind of pulling back because it's getting into that really crazy valuation, and real estate has the potential to really soar and take off as people look for, again, areas to invest their money where they can really get that interest that they're seeking, that they're not going to get from bonds, they're not going to get from savings accounts. So I want to take a lot of this cash here and put it into real estate. So you can see I've got about almost $1,200 that I want to get invested into real estate. My current 3 holdings are Realty Income Corporation, really solid company. They've been around for a long time. They paid a really reliable dividend. They've grown it over the years. That one is definitely my biggest holding. I have about $1,700 or so invested in that company. LTC, again, is a real estate REIT that focuses more on nursing homes and mostly for like the elderly, and obviously they have struggled with the whole coronavirus because of how that has impacted the elderly community. But I think in the long run, it's something that would eventually bounce back, especially with the vaccine again coming out. Store Capital, again, I got that one at a much better valuation than I did Realty Income Corporation, so that one's doing really well. I'd like to see it pull back a little bit, but we may not get it. So overall, I'm going to start adding more into the real estate, probably as early as this coming week when I sell Dominion Energy. But overall, you can see each of the sectors, the allocations that I have for those sectors, and how much I need to currently invest in those sectors to kind of get everything up to their target allocation. So we've got a little bit of work to do. We've got some cash to get invested, and with that, I mean, that's the plan going forward. So overall, I mean, we can see that the market it's just been churning higher. We look at SPY, the ETF that tracks the S&P 500, and it's a stone's throw away from all-time high. We're looking at about 1.3% or so from all-time high. So really, really incredible bounce back on the market. What happens when we get there? We don't know. I mean, we can look at the NASDAQ, which of course tracks a lot of the tech names, and it's been putting in all-time highs for quite a while. It just continues to go higher and higher. Perhaps it hits that the upper Bollinger Band here on the weekly chart around the same time the SPY hits its all-time high, and then we pause and maybe we pull back or maybe we don't. So overall, the market has continued to be strong. And again, we look at something like the Russell 2000, which of course is your small caps and everything, typically more risk on. So if you see investors pouring money into those small cap stocks, then perhaps they have a stronger belief that the market's going to continue to rebound. And so far, it continues to push higher. But you can see that there is, technically speaking, anyways, there's a lot of overhead supply here, and it's going to be coming right into that Bollinger Band on your weekly chart, which lines up perfectly with all of this upper resistance here. So we're not far away from some very important technical levels on the S&P 500 especially, and as you can see here, the Russell 2000, and then especially with the NASDAQ and tech really getting to incredible valuations. The longer this continues without any kind of a pullback, the more at risk we have of some type of volatile pullback. I don't necessarily think we're going to revisit those lows from March unless fundamentally things drastically change. But we could certainly see a significant pullback. We might see a pullback down to the 200 moving average here on the SPY, or it might even come lower. It might come back into the 200 moving average on the weekly chart. We just don't know. At this point in time, there's no reason to believe that that's going to happen, but we just need to be aware that the longer that valuations start to get out of control, especially in the tech sector, and the fact that those names in the tech sector have such a huge weight on the index as a whole, the more at risk the market as a whole could have some type of significant correction. So just be aware of that, but all we can do as investors is to continue to invest as usual. We're not trying to time the market. We're just investing our money for the long run. And we can certainly take advantage of any dip that comes whenever it does come. So with that, guys, I'm going to wrap it up there. That about covers everything. I appreciate you guys watching as always. If you do have any questions or comments, leave those below. I'll be sure to get to those. And we'll catch you in the next one. Thanks a lot as always. See ya.